Main event, though, for investors is going to be that Federal Reserve policy setting meeting, which gets underway tomorrow. It's a two-day meeting, and our Fed correspondent, Brian Cheung, is here now with a preview. So, Brian, I think the market pretty much understands there's not going to be a change in interest rates, but might we see the Fed say something a little different about the economic outlook?
Well, it might not even be what they say, Alexis. It might be about what they draw. And that's because of the new fresh round of dot plot projections that we'll get in this meeting. This usually comes quarterly anyways. Now, we haven't seen a projection of where we could see employment or inflation over the next 3 years or so. That's because we haven't gotten a fresh round of these economic projections since their last meeting in December. So the question is going to be, over the last 3 months, has the Federal Reserve seemed to see better signs of optimism in this economic recovery? And it seems to be yes, because of more people being vaccinated, obviously, since December, and the general feeling that we're getting towards the end of the light of that tunnel. Now, of course, the question is going to be, does a better improving economic forecast push the Federal Reserve to maybe then start to signal in those same dot plots that a rate hike would be coming sooner? Recall that in the last round of dot plot projections, the median dot showed no rate hikes through 2023. Could that change in the meeting this week? That's going to be the prevailing questions, because you have that very delicate message from the Fed that, yes, on one hand, the economic conditions and the rebound will be very nice this year, but the Federal Reserve is still going to hold pat on its extremely dovish policy, a very delicate balance for sure.
Yeah, because they need to reconcile this prospect of much stronger economic growth with this ongoing easy monetary policy. What do you think they might say about asset purchases? And might they wrap things up a little sooner rather than later? Might they do Operation Twist, which they haven't done in over a decade, and start buying up some of those short-term notes?
Well, for what it's worth, the baseline right now is $120 billion. That's the magic number that the Federal Reserve has floated since the fall of last year. That includes mortgage-backed securities in addition to U.S. Treasuries that they've been buying each month. Now, a very interesting operative word that a lot of people tend to forget is that they use the word at least $120 billion, which means the Fed had always had the option to be more flexible with its quantitative easing policy. So the Fed already has that option to, without needing to change any language when it comes to maybe making quantitative easing more aggressive. Now, what you're trying to get at with your question, I imagine, is whether or not the Fed will do so. One way they could get more aggressive, as you mentioned, would be an Operation Twist. You skew those purchases towards longer dated bonds like a 10-year or a 30-year so that you can lower longer term borrowing costs, because obviously the 10-year Treasury yield is a proxy for 10-year interest rates. So we've seen that rocket up by about 60 basis points since the Fed's last meeting in the end of January. So does the Fed feel the pressure to lower that? Now, what we've heard so far from Fed officials is still, these are historically low borrowing costs, even at 160 basis points for a 10-year business loan, for example, although we have started to see even 30-year mortgage rates go up. So that pressure is there. And again, this is that dynamic that we've heard Jared Blickley talk a lot about, the bond vigilantes in the market. Are they trying to dare the Federal Reserve to pull forward their forecast for that rate hike? Because that's where the 10-year is pricing. It's pricing in the odds of a 25 basis point hike by the end of 2022, the Federal Reserve saying that's not the case that we see so far. So who's going to win in that game of chicken? We'll see when we hear from the Fed chairman on Wednesday.
Brian, do you think that Jay Powell is going to focus more on unemployment and attaining full employment before he really tackles inflation? And is full employment for the Fed at around 4%?
Well, on the latter point, the Federal Reserve has not wanted to put a number on that. That's because they don't want to have some sort of bright line test where markets will get very jittery the closer and closer you get to a certain unemployment rate target. So the Fed's saying we don't have a specific number in mind. But broadly speaking, the answer to your first question is absolutely yes. The Federal Reserve actually changed its framework in the in the framework review that they had at Jackson Hole some time ago that said we are willing to have inflation overshoot 2% if it means that we can get a little bit closer to whatever our qualitative definition of maximum employment is going to be. Is that going to be something close to the 3.5% unemployment rate that was on the headline that we saw pre-pandemic, it's entirely possible. But the Federal Reserve is saying that is really our mission right now, to try to bring those workers back into the market. And this goes back into our first kind of question in this segment, which is the Federal Reserve is balancing that message. Yes, on one hand, the economic recovery, if you look at GDP numbers, is going to be quite nice in 2021. But keep in mind, despite the fact that over 100 million Americans had at least one vaccine dose so far as of this week, we still have 9.5 million people compared to pre-pandemic levels on the sidelines. By all measures, not anything close to a full recovery.
All right, Brian Cheung, this much anticipated Fed meeting, we're all waiting for it. And we're going to, of course, hear from the Fed Wednesday afternoon. Brian Cheung, thanks so much.